Hello and welcome to KYC. This is that show where we try and get you actionable insights on each individual company daily. Today we're going to cover Home First. It's an interesting company because one, it's in the housing finance space, domestic facing, and some of these housing financiers are growing at a very fast clip. So you want to first off check whether that kind of growth clip is sustainable or not, and that's the first piece what I'd want to know about this company. Can the growth clip sustain? 33% is what they've grown over the last 3 years. Can that kind of a number sustain? Maybe over the next 3 to 5 years is really the question. What helps them stand out? Because credit costs haven't gone up substantially despite that AUM inch up. So you want to understand what helps them stand out, or whether this is only a cycle with regard to credit costs. Can the cost to income fall? Is there scope for that? It's fallen over the last 3 years. Is there scope for further improvement on the cost to income front, which could well aid the return on assets number? What happens when private equity funds choose to exit? Now, mind you, there's a ton of private equity investors within the company. What happens when they decide, well, we want to exit? It could well pressure the counter, and therefore investors need to be mindful of how the private equity investors are choosing to exit. Now, one other piece with very much linked to the return on assets is the top line and spreads. The spread is generally the difference between the lending versus the borrowing rate for an NBFC. This one is seeing a shrink with regard to spreads. So is maintaining spreads a challenge? One thing is margins, the other thing is spreads. Spreads is on an ongoing basis and therefore is not impacted by the capital structure. I will explain this in greater detail, but is maintaining spreads a challenge? And last up is with regard to geographic expansion. They're currently in a limited geography, just about 13 states. As they grow, is there an intent to increase their geographic presence, and therefore does that pose a risk to asset quality? We'll talk about all of this and more, but first off, we'll look at one, what this company does exactly, and we'll try and break it down. And second, we'll look at all the metrics which we always speak about. So let me first start off with about the company. The company was incorporated on the 3rd of February 2010 in Bengaluru. It listed itself on exchanges in 2021. Between those two, converted itself into a public limited company in March of 2018. So that's how the journey has been. Listed in 2021, currently operates to 361 touch points, 155 branches, 13 states and union territories, larger focus on tier 2 and tier 3 cities. That's how they are spread. There you go, tier 2, tier 3 city focus. So that's how they are spread. Now, in terms of milestones and journey, again, we'll reboot. Commenced operations in 2010 after National Housing Bank registration that they got. They thereafter secured minority stakes from Bessemer Venture Partners and Tata Capital Growth Fund in each of the years, 2011 and 2013. Thereafter, they turned profitable only in 2014. They established a foothold in the affordable housing finance space. True North acquired a majority stake for over 600 crore with Ather Mauritius, which is a GIC affiliate, joining as a co-investor in the promoter group. They are still within that promoter group, and they still, on a combined basis, own 13% of Home First Finance. Warburg thereafter came in, acquired a 25% stake at 700 crore, and this was largely, of course, all of this was pre-IPO, so something to keep in mind. They signed co-lending partnerships with Union Bank of India in December 2021. They also launched their IPO in 2021. It was a 1154 crore IPO and subscribed 26 times, so plenty of interest. It also opened at a premium of 20% to the issue price. In 2021-22, they signed partnerships, Central Bank of India as well as Union Bank of India. Both of those partnerships coming through, they expanded reach thereafter, because they signed these partnerships. The AUM crossed 10,000 crore in May of 2024. That's the other milestone. They raised 280 crore from IFC for green affordable housing finance also in 2024. Thereafter, successfully 1,250 crore rupees raised through a QIP in April. They've boosted their capital, and the AUM is currently sitting at 12,700 crore. That's how the journey largely has been. Now, affordable housing finance, it's a fast-growing sector, doesn't need too much introduction, so I won't delve into that. But what we will delve into is the metrics, which we always do. Let's first start off with what are the metrics we look for. One, we look at the income statement. We'll thereafter look at the balance sheet, the operational metrics, and the asset quality. We'll also look at shareholding, valuation, street cred, street coverage, and in the middle of all of this, we'll look at the return ratios as well. So we will delve into how return ratios are also doing, even though that's not the metric we've looked at. Let's look at the income statement to start off. The net interest income has gone up by 29% over the last 3 years. That's the CAGR it's given in terms of the 3-year CAGR. You can look at the numbers, both FY24 and 25, which are on your screen. So healthy kind of growth that we've seen on the NII front. We've seen a bit of margin compression, but we will talk about that as part of operational metrics. The growth between FY24 and 25 hasn't been very sharp, and there are reasons for that. We will delve into that as well. Provisions, we've just about seen around a 5% 3-year CAGR on the provisions number, so no real concern per se there. And profit after tax has seen a 27% growth when you're looking at the last 3 years. In the last year or so, look at the kind of growth that it's clocked, 25% plus again. So very, very strong growth on the profitability metric as well. Let's look at the journey over the last 3 quarters now, and it's been fairly steady, as you can see. The provisions number is what I want to really highlight. No real inch up. It's been fairly steady. Profit after tax also nearly there. We've seen profit after tax for Q4 FY25 just inch up a marginal bit, and you can see that sequential inch up. It's a very healthy inch up. It's the first time where they've clocked profitability of 100 crore plus, which is in Q4 FY25. So making good progress in that sense. So a clear thumbs up with regard to this metric, just because some of the numbers really impressive in terms of growth. Now let's talk about the balance sheet, because that's the other piece. We've seen good AUM growth, 33%. We did speak about that over the last 3 years. Sustainability of this is the question. Borrowing number is at 41% when you're looking at it in terms of growth, and your capital adequacy continues to remain quite healthy at 33%. So no concerns here. Let's list out the key takeaways from the balance sheet as well, if we can. And the key takeaways from the balance sheet in particular are the healthy AUM growth that we've seen, strong capital adequacy that we're seeing. They have a guidance that their leverage ratio will be maintained at no more than 1:5. So they will not skew the balance sheet, or they will not add borrowing disproportionately. Every time it reaches 1:5, they will do an equity raise in about, not absolutely 1:5. And they've recently undertaken an equity raise of 1,250 crore on the balance sheet. So those are some takeaways for you with regard to balance sheet metrics. Let's look at asset quality now. And thumbs up on the balance sheet. Sorry, let's look at operational metrics now. When you're looking at the operational metrics, we'll see that margins have slowly crept downwards. So from the 6.4% number, they've come down to 5.2% at this point. Spreads also have seen a similar kind of trajectory, but the difference is lower. Now, in terms of where margins is concerned, very important to understand this. The margin number is linked to the net interest income number. The net interest income number is linked to the interest expenditure number. The interest expenditure number is linked to the borrowing that the company does to do onward lending. Whenever a capital raise comes in, an equity capital raise comes in, you have to borrow less in that particular year, right? Or in the subsequent year as well, because you have adequate capital. If you do not do an equity raise, then you have to do a debt raise to ensure that growth comes in. Now, whenever there is an equity raise, the equity that comes in as capital then goes out and earns you interest income. But there is no interest expenditure linked to this interest income. And therefore, you will see interest expense remain flat, but interest income go up, which means your margins will see a bit of a lift. And that will only be temporary. Your normalized margin will very quickly be reached as that capital gets completely utilized, and you have to thereafter raise debt to ensure that your 1:5 leverage starts to kick in. For the moment, this margin movement is largely because they haven't done an equity raise from FY23 to FY25. FY25 is when they've done the equity raise. So you might likely also start to see a bit of an inch up in terms of margins temporarily. Thereafter, it may be a year or two till the next equity raise that you will see a gradual fall with regard to margins. So that's how the margin trajectory will go. We will quiz them as to what the goal is with regard to margins, but the better number is the spread number. The spread is the absolute difference between what you are lending at versus what you are borrowing at. And therefore, that spread number is what is relevant. When we look at the spread number, we'll realize that that has also fallen, and that's where likely the concern is. The ROA number though is fairly steady. At 3.5%, ROA is very healthy. It's come off a little bit from that 3.9%, but that's also because of what I just explained in terms of interest expenditure. The ROA, which is the profitability, is linked to the interest expenditure, and as the interest expenditure has gone up, right, because they have not done any equity raise over the last 2 to 3 years, because the interest expenditure has gone up, you've seen an ROA dilution, and therefore you will see that also as a very, very normalized piece. It's within the realms of the way Home First does its business, and therefore no concerns at all. What you want to though look at is borrowing cost. Between FY23 and FY25, we've seen the repo rate go up and the borrowing cost has inched up. Is there scope for this to come back off? And what is the impact on spreads and margins? That's what you want to really look at, and thereafter assess the impact of that on your ROA and profitability. I hope that this kind of sums up in a nutshell all that's reflecting on your screen. The other piece is the OPEX to assets. OPEX to assets has come gradually down, as you can see. It's a healthy gradual taper. Can this taper continue going forward? It will be the question, because that will also impact your ROA number and your profitability. As your OPEX grows not as fast as income grows, right? If your OPEX is not going to inch up as fast, then you really, then you will see an impact of that on profitability. So you'll see better profitability on the back of that. That's on the operational metrics. Now let's look at asset quality very quickly. It's largely steady, but it's above the 1% threshold in terms of NPAs. So in that sense, it's a neutral. We've seen other housing financiers clock a lower NPA ratio absolute, but no concerns per se on the asset quality front. Let me just clarify that. Where shareholding is concerned, there are large PE investors which are involved. You look at the promoter holding. Within that promoter holding, there are very large PE investors. There's a True North. There's a GIC, which we spoke about, but there are also others. Even within the DII basket and even within the public basket, there are plenty of investors which are there, which hold chunky holdings, who will eventually want to exit. How does this exit happen will be the question, but for the moment, you're seeing one, marquee investors, which is a positive, but two, you might see them at some point of time sell as their funds expire. Not that they want to sell, but because their funds will expire and they'll require the money to pay out back to the investors. That will actually impact both the shareholding pattern as well as liquidity in the stock, which could impact the stock price performance. So we've given this a neutral therefore. Last couple of pieces. One, you have valuations. When you're looking at the valuation picture, and let's pull it out very, very quickly. There you go. Your price to book, and I've tried to sum this up. Maybe you can take a screenshot of this. What you can actually see is the price to book for Home First versus the 3-year average is at a slight premium. It does an ROA of 3.5%. Let's ignore Canfin for the moment. Let's compare absolute comparables. Aptus 4.24, 4.49, slight discount to 3-year average, and you look at the ROA 7.7%, but this ROA is not sustainable because they have a very, very high amount of equity. They still need to leverage the balance sheet. So again, not the right comparable. Let's look at Aadhar, right? 4.36 price to book, 4 times is the 3-year average price to book, and 4.3% ROA. So the ROA is better, the price to book is largely in line, and the 3-year average, this one is trading at a far sharper premium. Last one is an Avas. And Avas is trading at 3.9 times, 4.2 times is the average, so it's trading at a discount, and 3.2 times, so sharply lower in terms of ROA. So this is your available universe, right? I'm not saying that some of them don't look expensive, but you compare it to a Canfin Homes where your ROA is 2.25%. Your discount to 5-year average is quite sharp, right? And maybe Canfin looks far more attractive in relative terms versus some of the others. And therefore, you might want to analyze this a little bit more. But for the moment, we're going to give the valuations which are extremely steep at 4.4 times, extremely steep, probably the most expensive among all housing financiers. You want to give this a thumbs down, plus it's trading at a premium to 3-year average. So you might want to be cautious with regard to where valuations is concerned. Let's look at Street Cred. Now, in terms of the returns that the stock has given, it's been decent. 2% up last 1 month may not have been very impressive, but you look at the last year or so, and it's been a decent performance from a stock price perspective, 47% up over the last 1 year. So very strong performance. We'll give this a thumbs up as well. And you look at street coverage. When you're looking at the street coverage, 22 buys, 1 hold, 1 sell, 17% upside. Nothing to complain about per se. We'll give this a thumbs up as well. So that's how it all stacks up. Now, the rating parameters, thumbs up on income statement, balance sheet, operational metrics, asset quality. Also, shareholding pattern, you might want to be a little cautious. Valuations, definitely cautious. Street cred, thumbs up. Street coverage, thumbs up. It sums up a 6 out of 8 on our KYC ratings. Not bad at all. But let's quickly go on. Let's listen in to what the management had to say. We spoke with Manoj Viswanathan, who is the Managing Director and CEO of the company earlier. Listening.
This year, we ended the year at 12,700 crores of income. And we have set a target for ourselves for FY27. That is a kind of a round number of 20,000 is what we have set for ourselves as far as FY27 is concerned. And then a slightly longer term, that is FY30, our target is around between 35 to 40,000, depending on how tailwinds are, how the economy is doing, etc. So that is broadly our plan. 20,000 in the next 2 years, FY27, and between 35 to 40,000 crores by FY30.
Should a 25% odd growth clip be something which is the absolute base that we can expect in terms of growth for Home First?
So yeah, next 2 years, we are looking at a 25 to 30% AUM growth. We have been, what we had mentioned was that we can grow at about 30%. That is what we mentioned when we listed the company in FY21. And we have been growing at between 30 to 35% in the last 4 years. Now what we are seeing is that the base is obviously elevated. So we are saying that 25 to 30% should be a sustainable growth over the next 3 to 5 years. And for the next 2 years, at least the target is 20,000. So that translates to somewhere between 26, 27 or, around 27 to 30% in that range. That is the growth for the next 2 years.
Tell us, there are 3-4 players in this space, in this affordable housing finance, or the smaller both ticket size as well as smaller size in absolute terms on the balance sheet. There are 3-4 players. What sets you apart? What makes you unique? And how does that help you stand out?
So as far as the balance sheet is concerned, I think one thing that sets us apart is the share of housing in the book. So we have 85% of our loans devoted to individual housing loans. which is the highest share amongst the peers that we are talking about. So that is something as far as the balance sheet that sets us apart. In terms of the business model, business process, I think what sets us apart is our you can say dedication, devotion to technology, using technology to facilitate things from day one. So we have been one of the early adopters of the Salesforce platform, centralized underwriting model, AI-based or AI/ML-based underwriting. So these are things that have that are things that we have kind of built over the years, and which have also led to some financial metrics or results, like low operating expenses. So if you see our operating expense to assets, it is the lowest amongst the peers that you're talking about. And that is directly a result of our approach to the business, that is using technology, designing the process in such a way that the cost is optimized.
Point taken. And how does that help you going forward? You've given us some bit of color on how it's helping you currently, which is to optimize OPEX. OPEX now at OPEX to assets roughly at 2.7% for viewer perspective in Q4. But how does that help you in terms of numbers going forward? So say maybe a couple of years from now, is there scope for further contraction of this when you get to that 20,000 crore mark in terms of AUM?
It is possible. So by design, I mean, the design is that, the cost should keep getting reduced. And, but how much it will reduce from here on, can't really, put a number to it. But of course, because of the way we are designed, the OPEX should keep going down. So our estimate is that every year it should, or every 2 years it should be able to, we should be able to reduce it by about 5 to 10 basis points. So 2.7, so maybe get it down to about 2.6 in the next couple of years. Because I mean, the reason I'm saying that is that we are already very, very well optimized on cost, and our OPEX to assets is amongst the lowest compared to all these peers you're talking about. So we would rather focus on growth at this point of time rather than trying to optimize the cost any further.
And how does the spread move in this reducing interest rate environment? Give us an understanding of that. Do you expect yields to follow?
Yields continue to remain under pressure, but I think most of the players in this segment, affordable housing segment, understand that there is a certain minimum margin that we have to maintain to keep the business profitable, and so obviously that acts as a moderator. So I think generally speaking, most of the players are looking to maintain a 5% plus kind of a spread on an individual loan. So hopefully that should moderate the yield pressure going forward. Unless something really draconian happens and the operating expenses are really dramatically reduced for across the board for all the players. Then some of that benefit could get passed on to customers, and the spread could compress further. But otherwise, I would say that a 5% spread is something that most of the industry players in this segment they accept it as a reasonable spread that needs to be maintained.
Right. You have a fairly good visibility on the glide path with regard to AUM. You've done a 1,250 crore fundraise. How long does that last you for? At what level of AUM will you again look for an equity raise? And how many years ahead are we seeing no equity dilution for?
So we are clearly on track to hit till FY29. So the 1,250 crore raise should keep us, I mean, it will basically now, I mean, it's a function of leverage, right? So we were already hitting a 5 times leverage, so hence we raised the capital. So it will be again another at least 4 years before we start hitting that 5 times leverage number. So maybe FY29 is when we can start thinking about the next capital raise, but we should be good till then.
And before I talk about credit cost, tell us about both the interest expense part of it, because that will start to climb in relative terms, and your ROAs. So therefore, what is the band of ROA that you'd like to operate in, and does it get better? Does it get slightly trimmed down, given that you'll have this capital of equity and debt which will play on the P&L as well?
So we have always articulated that ROA is probably not the right metric because the ROAs tend to fluctuate depending upon the leverage. So when the leverage comes down, like now it would, because we have just raised the capital, the ROAs tend to expand because the NIMs tend to expand because the debt on the balance sheet is proportionately lesser, because of the capital raise. So the NIM tends to expand and the ROA also tends to expand a little bit. So the ROA would, in our mind, the ROA would fluctuate between 3 to 4 depending upon the leverage. So in the years when the capital has just been raised, so the ROA would be closer to 4. As we kind of head towards the higher leverage of about 5 times, the ROA would tend towards 3. So which is why we are more, we anchor ourselves more to the ROE number. And our aim is that we want to, we actually exited with an ROE of 17% last quarter. And our aim is that between capital raises, we should be able to deliver a 16 to 16.5% average ROE for the shareholders. So immediately after capital raise, ROE is likely to shrink to about 13 to 14%. And then again, it will climb back up to about 17 to 17.5%. So on an average, between capital raises, our aim is to deliver a 16 or 16.5% ROE.
Understood. And therefore, so if ROA is not the right metric, is ROE the right metric? What's the right metric? Because both of those will fluctuate. So just trying to get perspective on that.
Yeah, both will fluctuate, but ROE being the final number in terms of return to the shareholder, we kind of want to anchor to that number. So the idea is that average ROE between capital raises, I would say, would be the right metric to track.
Right, so that was the conversation, of course, with the management of Home First Finance. Interesting company. Hope you found this breakdown interesting as well. Completely out of time on this edition from myself and everyone who puts the show together. Packed team, all of them. Thanks so much for watching and stay tuned to NDTV Profit. More action on the other side.